Have you ever noticed how sometimes the biggest financial mistakes are not made because people are careless, but because they think they are doing everything right? That is exactly what is happening right now to millions of retirees. Many seniors spent their entire lives saving carefully, avoiding risk, listening to advice, and planning for a peaceful retirement. But there is a rule that changed recently, and many people still do not know about it. And the scary part is they do not even realize they are losing money until it is already gone. This is not a scam and not a trick. It is a real tax rule, and the problem is that it sounds small, almost boring. So people ignore it, yet it can quietly cost thousands of dollars over time. The rule is about retirement accounts and mandatory withdrawals, and most people think they understand how retirement withdrawals work because they learned it years ago. But the law changed and they are still following the old system.
For decades, retirees were told they must start taking money out of their retirement accounts at age 72, and that idea became so common that financial habits formed around it. People planned birthdays around it, advisors repeated it, and calculators online were built around it. But the age moved and many people still live mentally in the past rule. Today the starting age is higher, and that sounds like good news because you can delay taxes longer, but confusion created a strange situation where some people withdraw too early and pay unnecessary tax, while others withdraw too late and get penalized. Imagine saving for 40 years and then losing money just because you followed outdated advice you trusted. That is what is happening. When you save in traditional retirement accounts, the government allowed you to skip taxes while you were working, but they never intended that money to stay untaxed forever. So at a certain age, you must begin taking a minimum amount every year whether you need the money or not. This amount is calculated using life expectancy tables, and the number changes each year, which already sounds complicated enough, but now add the new age rules and penalty changes and the confusion multiplies. Some retirees think the government removed the requirement entirely and they relax too much. Others think nothing changed and they rush to withdraw money early, and both situations can cause damage. The biggest shock for many people is the penalty because it used to be extremely severe and now it is lower, yet still painful. If you fail to take the required amount, you can lose a large percentage of what you should have withdrawn, and that penalty applies even if the mistake was innocent. Many seniors do not even notice until they file taxes months later and suddenly discover they owe money they never planned for. That moment feels terrible because retirement is supposed to bring stability, not surprises. Another problem is timing, because the first withdrawal has a special deadline. People think they have until the end of the year, but the first year works differently, and delaying can accidentally create 2 withdrawals in the same year, which pushes income higher and increases taxes. That extra income can affect other things too, including medical insurance costs and taxation of benefits, and retirees are shocked because they did not feel richer, yet their bills increased. A very common mistake happens when someone continues working part-time and assumes the rule does not apply yet, but the rule depends on account type and employer plan structure, so assumptions can be dangerous. Another big change many people missed involves certain retirement accounts that no longer require lifetime withdrawals, meaning some retirees are voluntarily paying taxes they could legally avoid simply because they are following old habits. Imagine taking money out, paying tax, and then reinvesting it in a regular account that will now be taxed again in the future when it could have stayed protected longer. That is not illegal, it is just unnecessary, and it happens quietly every day. The reason this mistake spreads so easily is because people trust old articles, old videos, and advice from friends who retired earlier under different rules. Financial knowledge expires faster than people think. What was correct 5 years ago may now be outdated. Another reason is emotional behavior. Many retirees fear breaking rules, so they over-withdraw to feel safe, but ironically, that safety costs money. Others avoid dealing with paperwork because it feels complicated and stressful, so they postpone action until it becomes urgent, and urgency is where errors happen. There is also a psychological trap where people see their retirement account as a savings vault rather than a tax arrangement. They think withdrawing small amounts does not matter, yet every withdrawal changes taxable income calculations. Over time, those small decisions stack into large consequences. Consider a retiree who withdraws more than required for convenience, maybe to simplify accounts, and later discovers they moved into a higher tax bracket permanently. The extra tax repeats every year, not just once. Many people also misunderstand how different accounts interact. Withdrawals from one account might satisfy requirements for multiple accounts if done properly, but if taken incorrectly, each account might require separate withdrawals, doubling taxable income. This is why two retirees with identical savings can pay completely different taxes simply due to timing and strategy. Another hidden cost appears in healthcare premiums. Income thresholds determine monthly costs, and crossing them by a small amount can increase yearly expenses dramatically. Seniors often blame inflation, not realizing the real cause was one large withdrawal they made months earlier. The change in withdrawal age created a gap period where careful planning can reduce lifetime taxes, yet few people take advantage because they are unaware. During those years, income is often lower, providing an opportunity to manage taxes intentionally, but most retirees wait until forced withdrawals begin, losing flexibility forever. The story here is not about complicated investing or risky decisions. It is about small administrative rules shaping financial life. Many people assume retirement planning ends when they stop working, but in reality, the management phase becomes more important because mistakes cannot be corrected easily without penalties. Another reason confusion spreads is that different birth years have different starting ages, so neighbors and siblings may follow different rules. Advice that worked perfectly for one person may be wrong for another just 1 year younger. Humans naturally trust personal stories more than official instructions, which is why misinformation spreads quietly. The good news is that the problem is preventable once understood. Checking account types, confirming deadlines, and calculating minimum withdrawals accurately can protect savings. Yet people delay because paperwork feels intimidating. The emotional weight of finance increases with age because people fear making irreversible errors, and that fear ironically causes inaction, which creates the very error they wanted to avoid. A simple calendar reminder could prevent thousands in penalties, but habits formed decades ago are hard to change. There is also a mental shift retirees must accept. During working years, the goal is accumulation, but later the goal becomes controlled distribution. Many struggle with this transition and either spend too slowly or withdraw chaotically. The rule exists not to punish, but to ensure taxes eventually occur. Yet without awareness, it feels like punishment. Stories circulate about friends who suddenly owed unexpected taxes, creating anxiety in communities, yet often the cause traces back to misunderstanding the withdrawal schedule. People often think financial mistakes require dramatic market crashes, but quiet regulatory details cause more consistent losses. Another surprising issue happens when someone inherits an account and assumes the same withdrawal schedule applies to them, which can lead to major penalties because inherited accounts follow different timelines. Families dealing with grief rarely focus on tax details, so errors happen at the worst emotional moment. Advisors frequently say the biggest retirement risk is not market volatility, but behavior and misunderstanding. The rule change amplified that truth because it created a transition period where old knowledge and new law overlap. Some retirees heard about the change but only partially understood it, which can be worse than ignorance because confidence prevents double checking. Overconfidence leads to ignoring official notices mailed by institutions that actually contain important instructions. Many letters look like routine statements and get filed away unread. Months later, tax season reveals the hidden importance. The financial system assumes individuals read communication carefully, yet most people skim documents, especially when language feels technical. Clear understanding turns a confusing rule into a simple routine. Know the correct age, know the deadline, calculate the amount, withdraw on time, and record it, but missing one step triggers consequences. Think of it like renewing a license. The process is simple, but forgetting the date causes fines, except here the fine can be thousands. Retirement should feel predictable, and rules like this become stressful only because they are learned late. Education earlier would remove fear. Many younger workers watching today may think this does not matter yet, but habits start early. Keeping organized records and learning account types prevents confusion decades later. The lesson is larger than a single tax rule. Systems evolve, and financial plans must evolve with them. The danger is assuming stability where change exists. The The comforting part is that correcting the mistake quickly can reduce penalties significantly if handled properly, but speed matters and waiting worsens the outcome. Awareness is therefore valuable even if you already made an error because action can soften the damage. Ultimately, the biggest takeaway is simple. Retirement money has rules attached, and those rules change quietly over time. People who stay informed keep more of what they earned, and people who rely on memory from years ago unintentionally donate part of their savings back. The difference between those two groups is rarely intelligence or discipline. It is just updated information. That is why conversations about boring topics like withdrawal schedules become powerful. They protect decades of effort. So if someone believes retirement planning ended when they stopped working, this rule proves otherwise. The planning simply changed form, from earning money to managing timing. And timing, not just amount, determines how much of your savings truly belongs to you in the end.